Alright, starting with another video on startup. We are going to continue with the Founders Club blogs. If I can bring it up. Last time we skipped the chapter, so this understanding startup investments. There are 5 chapters with an introduction, and we're at chapter 2, and we skipped this part. And I think this video is gonna be around 40 minutes, 40-50 minutes. So I try to cover chapter 1 and 2. And we have the note ready, so whenever we need to write something, we can use that. Alright, startup equity investments. This probably is going to go through the terminology of investments, equity, stocks, things like that. How startups investing works on TV. A panel of investors lean back in large leather chairs, entered the startup founder, dressed in Silicon Valley chic casual. Jeans, t-shirt, hoodie, flip-flops. Chic, casual. The startup founder delivers an enthusiastic, if somewhat shaky pitch, ending with the figure he needs to keep his company afloat. 500,000 for 10% of his startup. The investors nod approvingly at the bags under the founder's eyes and his or her rumpled attire, noting the signs of sleep deprivation and lack of self-care as devotion to business. They ask a few questions, confer with one another, and make a counteroffer. 55% of the business for 500,000 investment. The founder tries to negotiate to no avail, paces back and forth a little, steps outside to phone a trusted friend for advice. Eventually, the founder decides that he or she needs to take the deal, even if it means giving up majority control of the company. If the founder doesn't take it, the business will go under. This is a stereotypical display of the hopeless founder and money-hungry rich investors is highly dramatic and an example of poorly negotiated equity investing. Okay, that's just a term. How startup investing really works. A few people get together and come up with innovative solutions to a common problem. They test out their new solution, iterate a little, and find something that works and that a sizable group of people actually want to use. Inspire. This brand of innovative thinkers decide to turn that early idea into a company. But to fulfill that dream, they'll need advice from seasoned entrepreneurs who have built successful companies before and money. This is where startup investors come in. In Silicon Valley and beyond, early stage startups can raise venture capital from VC firms and angel investors in various ways. And in reality, they happen very differently than in the theatrical scene above. We are going to explore the different types of early stage investments that give promising startups the cash flow they need to start chugging toward that IPO. And when investors are likely to encounter each investment type, equity investments and convertible investments are both securities or non-tangible assets. For example, shares of stock in Apple or a government bond. Tangible assets refer to physical investments like diamonds or real estate. There are two main ways to invest in early stage startups. Investing in a priced equity round. Investors purchase shares in a startup at a fixed price. Investing in convertible securities. The investment amount eventually converts into equity plus the name. Hmm. The priced equity round and investing in convertible securities. Alright. Seed and early stage investors often invest in startups via convertible securities such as convertible notes and Y Combinator's safe documents. Um, Investors in later stages startups, Series A or later, will more commonly invest in priced equity rounds. Why do startups raise venture capital? Venture capital is an ideal financing structure for startups that need capital to scale and will likely spend a significant amount of time in the red to build their business into an extraordinarily profitable company. Big name companies like Amazon, Facebook, and Google were once venture backed startups. Unlike car dealerships and airlines, companies with valuable physical assets and more predictable cash flows, startups typically have little collateral to offer against a traditional loan. Therefore, if an investor were to issue a loan to a startup, there is no way to guarantee that the investors could recoup the amount they've lent out if the startup were to fail. By raising venture capital rather than taking out the loan, startups can raise money that they are under no obligation to repay. However, um, however, the potential cost of accepting that money is higher. While traditional loans have fixed interest, startup equity investors are buying a percentage of the company from the founders. This means that the founders are giving investors rights to a percentage of the company profits in perpetuity, which could amount to a lot of money. Early stage startup investing offers potential for astronomical growth and outsized returns relative to larger, more mature companies. This potential makes acquiring startup equity an attractive investment opportunity to prospective investors despite the additional risk. For the founders, taking VC money can also come with huge benefits. Startup investors can offer valuable support, guidance, and resources to new founders that can help to shape their company and increase its chances of success. Venture capital financing is also ideal for startups that can't get very far by bootstrapping. Although many founders self fund their startups while operating out of a cramped apartment until they've reached profitability. I think I read this, but it's good that we are reading it again because I don't remember. I didn't remember till this. But bootstrapping doesn't work for companies that require a lot of capital upfront. Just just to build and test their MVP, minimum viable product. What is equity? Equity essentially means ownership. Equity represents one's percentage of ownership interest in a given company. For startup investors, this means the percentage of the company's share that a startup is willing to sell in to investors for a specific amount of money. As a company makes business progress, new investors new investors are typically willing to pay a larger price per share in subsequent rounds of funding as the startup has already demonstrated its potential for success. For success, when venture capital investors invest in a startup, they are putting down capital in exchange for a portion of ownership in the company and rights to its potential future profits. By doing so, investors are forming a partnership with the startups they choose to invest in. If the company returns a profit, investors make returns proportionate to their amount of equity in the startup. If the startup fails, the investors lose the money they've invested. What is the difference between stock, shares, and equity? The terms stock and equity are often used interchangeably. Stock is a general term that refers to an unspecified amount of ownership interest in a company. Shares represent the way that a company's stock is divided. A company's stock can be divided into a potentially limitless number of shares, each worth exactly the same. In a priced equity round, shares. Okay, so price equity round, as in there's a price on the stock. Shares in the startup have a fixed price, and investors can purchase equity in the company by buying shares at the price during that round. When Ashton Kutcher and Guy Oseary made a joint investment of 500,000 in Airbnb's Series C round for an estimated 0.25 equity stake. They effectively purchased 0.25% of Airbnb's shares. This means that, assuming they were 400 total shares, Kutcher and Osei's 0.25 stake would represent one share, or a quarter of a percent of the company. Calculating, what should we use that now? Airbnb capital market cap. Alright, 80 divided by 100. It's 200 million. That's pretty good, I think. Anyways, well, of course, they need to find someone who's willing to buy everything at this price, but it's good enough. I think they can come down to 100, half of that price. Anyways, the total, equity ownership, number of shares owned divided by total outstanding shares. The total number of outstanding shares in the equation above refers to all shares that exist today, including all shares purchased by investors, in addition to all shares likely to exist if a liquidity event were to occur. How can a share be likely to exist? When calculating an investor's equity stake in a company beyond existing shares issued, it's important to account for both investments via convertible securities, which haven't converted to equity yet, and any stock options issued to founders and employees or authorized for future issuance. Founders and employees generally are granted the stock options, which give them the right to purchase a fixed amount of stock in the company at a pre-agreed upon price. At a pre-agreed upon price, commonly referred to as a strike price. While the investors and founders and employees in the above situations may not technically own those shares yet, the shares have already been in fact spoken for. Therefore, they cannot be issued to any other investors and must be accounted for in the total number of company shares. I see. The total number of outstanding shares. It's all shares, but outstanding. I'm writing it down. And a company increases every time a startup issues additional shares. New shares are commonly issued when a new investment in the company occurs. Issues a new random funding closes. A founder or employee is issued shares as part of their compensation package. The employee option pool is refreshed, pop quiz. If the denominator is constantly increasing and the numerator remains the same, does your percentage of decreases? Okay, if you answer decrease, you're right. Every time a company issues more shares, a shareholder's percentage of equity is subject to change. When a previous shareholder's percentage of equity decreases due to additional shares issued during a later round, that is called dilution. Some shares of stock are issued along with the special rights designed to help investors maintain their percentage of ownership interest um, in the company. We dive further into preferred stock rights and terms in chapter 2 of this guide. I remember. It was the private, so private one was it? If you want to sell it, you have to come back. You have to give me the option to buy it first. At a price, or it wasn't at a price? Anyways, who can own equity in a startup company? Often, startup founders, employees, and investors will own equity in a startup. Initially, founders own 100% their startup's equity, though they eventually give away the majority of their equity over time to co-founders, investors, and employees. Venture investors choose to invest in startup companies, private companies, because they stand to make outsized gains if the company goes public, or if another liquidity event occurs, such as an acquisition by another company. Employees are often offered equity in the startup where they work as part of their compensation package. Employees may elect to receive lower monetary compensation in exchange for a greater amount of equity in the company. In turn, the equity serves as an incentive for employees to stick with the startup as it grows, as their shares typically vest over a period of time. Alright, that was good. Let's jump to chapter 2. We already read chapter 1. We can just quickly go over. Oh, wait. Okay. Oh, I feel like I was reading VC. So, what was I reading? I'm not even sure. Okay, back to this. Chapter 1. Did I read the introduction? Yeah, okay, let's continue with chapter 2. Common versus preferred stock. Startups can grant special privilege to preferred stockholders to protect them against loss in valuing their investment. Different types of equity are available to various stakeholders within a startup. Equity generally breaks down into common stock and preferred stock. Preferred stockholders, also called preferred equity holders, have greater claim to the company's asset than common stakeholders. They are first in line to collect a payout if solvency event lower than the company's valuation occurs. Think bankruptcy, mergers, and acquisitions. Companies will sometimes divide some common stock equity into two classes: common A stock and common B stock. Common A stockholders taking priority over common B stockholders. Startup investors typically hold preferred stock equity, whereas founders generally hold common stock equity. Employees often hold options that grant them the right to purchase shares of common stock equity. Employees often hold options that grant them the right to purchase shares of common stock equity subject to vesting schedules. I keep hearing the word valuation. Valuation refers to the amount that a startup is worth because most startups aren't turning a profit yet. A startup's valuation describes the amount that founders, investors, and shareholders decide that the company is worth. This number is based on the price per share that investors are willing to pay in order to invest in a startup during a particular round or stage. Ashton Kutcher and investment partner Guy Oseary invested $500,000 in Airbnb Series C round for an estimated quarter% equity stake. At the time, Airbnb had a 200 million valuation. Airbnb is currently valued at 30 billion as of August 2016, making Kutcher and Osiery's share grow currently worth an estimated 75 million, assuming no share dilution in later rounds. Valuation can change every time an event occurs that impacts the worth of investors' shares in the company. Share value can also fluctuate depending on how many additional shares the company issues to later stage investors. In follow on rounds of funding, events that can impact events that can impact the startup valuation. Company progress typically leads to an increase to valuation. Company challenges typically leads to a flat line or even decrease to valuation. Market dynamics, new priced equity rounds, acquisition, or IPO. To calculate the value of an individual investor's share in a startup at any given time, multiply the number of shares the investor owns at the company's current price per share. This is not good investment value. Because I want to say, in the perfect market, at least there is that much it's not perfect if it's like that. That there's enough. What is it called? What is it called in crypto? The amount that it's circulating. So you cannot just turn your equity or whatever to money at that price. So this you need to be a little bit careful. Uh, how much someone's willing to buy your thing because they see that you want to sell. You might show desperation. You might show a need, and then they will take care of it. So, sort of, if you can sell to as many at the right time, that would be the best, sort of. Hard money valuation refers to the change in valuation after a price equity round occurs. This is generally a higher number than the pre-money valuation, though in a down round, post-money valuations can be lower than the pre-money valuation. Okay, preferred stock rights and terms. Preferred stock rights help to minimize investors' exposure to risk in future funding rounds. Right. Investors who receive preferred stock can negotiate a set of terms that are favorable to them in the event of a drop in the value of their investment, such as a down round, when a company raises funding at a lower value than the previous round, or when a company issued that's a down round, when it issues additional shares which dilutes an individual investor's percentage of equity in the company. In most cases, all investors in each round will be granted the same set of preferred stock rights and terms. The actual rights included in a given investment will vary, and we recommend conducting legal diligence on each individual investment. Or liquidity when you sell. The other term is volume. See, the volume is 6 million. Is it 6 million shares? Oh. Everyone shares outstanding. Here we go. Zero point 645 million. All right, let's move on. Terms of investment specifying which investors get paid first and how much they will get paid if a liquidation event occurs. Liquidation preference is typically used to protect preferred investors by making sure they get their initial investments back before common shareholders, including founders, employees, and previous investors. Um, I see. All right, pro rata rights. Pro rata rights help existing. Okay, so liquidation. Someone gets paid first. So is that so? Like in an event of like merger and acquisition, then someone's paid first. Someone's doing that. Someone's doing this. You see. So they're selling companies to each other. The biggest investor or someone with liquidation preference have a say, and that could create a dynamic that can be tangled up, or even it could lead to more straightforwardness. Could happen too. Pro rata rights help existing investors maintain their percentage of ownership in the company via additional investments. Often, companies will grant larger investors in early rounds of funding the right to participate in subsequent rounds. Via this right, investors can decide whether to exercise their pro rata rights in subsequent rounds of financing depending on their Okay, companies will grant larger investors in early rounds of the right to participate in subsequent rounds. Via this right, investors can decide whether to exercise their pro rata rights in subsequent rounds of financing depending on their investment strategy. I see. However, pro rata rights aren't entirely future proof. Investors at later rounds may attempt to waive the pro rata rights of earlier investors. Pro rata rights also typically only apply to a single subsequent round and typically do not apply in perpetuity to all future rounds. Oh, interesting. Um, Pro rata preferred investors. Pro rata. Okay, Twitter founder Bezos Stone invested 42.7 million Slacks um, Series C round at a 2.8 billion post money valuation for a 1.525% equity stake. When Slack raised its $200 million Series D round at a 3.8 billion post money valuation, they gave away 5.26% of the company, diluting all existing shareholders by 5.26 as well. Okay, Bezos, his name is Bez. No wonder he's so rich. Okay, his real name is Christopher Isaac Stone. They call him Bez. Fair enough. Fair. At a 3.8 billion post money valuation, they gave away this. Okay, and Bezos' initial holdings in the company are diluted to 1.44% pro rata rates would dictate that business could have chosen to invest an additional um, an additional 3 million 0.08% of Slack at the 3.8 bill valuation in the Series D round to restore his holdings to 1.525. I see. Anti-dilution. Alright. Shares granted with anti-dilution rights protect uh, earlier equity investors in the event of future decrease in the value of their shares. In the event of a down round, anti-dilution rights kick in and issue additional shares to previous investors who invested at a higher valuation. Most, but not all, equity financings led by venture capital investors include anti-dilution rights for preferred investors. Okay, this is where we're getting to the goodies. However, investors in later rounds may request to waive anti-dilution rights granted to investors in previous rounds. Follow-on funding will almost always result in a small amount of dilution for previous investors, as the company valuation is increasing while the investor's amount of ownership interest remains the same, which is why pro rata rights explained above help investors maintain their percentage of ownership interest in the company. Alright, anti-dilution rights can protect investors from their of ownership interest shrinking dramatically in the event of a drop in valuation or down round. A drop in valuation is generally a negative outcome for companies, and investors tend to hope that their anti-dilution rights never have to kick in. Okay, so there are three anti. Okay, I won't be able to get to all of this, but that's what we can do. Okay, maybe this is covered. Okay, the exact calculations governing how investors are compensated for any lost value depend on the type of anti-dilution rights initially granted to the investors. To better illustrate how each type of anti-dilution right can impact investor share value, we've created several fictional sketches surrounding Foursquare's down round in January 2016. Social networking service. Founded in 2009. What do these guys do? Okay, so Foursquare Labs, commonly known as Foursquare, is a geolocation technology company and data cloud platform based. Founded, the company rose to prominence with the launch of its social search and discovery mobile app. The app Foursquare City Guide popularized the concept of real-time location sharing and checking in. Oh, interesting. All right. All price per share information used in this example is for illustration only and should not be taken as investment advice. No anti-dilution rights. Common shareholder, such as founders, startup employees, generally do not hold anti-dilution rights and are therefore not protected against loss in the value of their share. Imagine you invested 500,000 in Foursquare's Series D round at a 700 million post-money valuation. You bought 38,640 shares of common stock at 12.94 per share. With no anti-dilution rights, Foursquare later goes on to raise a Series E round at a 3.307 million post-money valuation. Okay, the overall value of your investment is now. Oh, I see. But wait, I thought for the dilution thing is that your percentage of the company doesn't change, and pro rata gave you the right to be offered those stocks that first, if you're going for a round, then you do that. Okay, furthermore, the price per share dropped 69% to 4.01. How much was the share? 12.94. Okay. Now your shares are worth 150,000, about 69% less than their value at the time of initial investment as a common shareholder. You would not be entitled to any additional shares to make up for a decrease in share value. Maybe I'm wrong. Need some more search. I thought it's percentage keeper, but Currently, it also applies to series keep your yeah, full ratchet anti-dilution. Okay, probably the last one we can go through. The company agrees to issue shares to investors to make up for 100% of 100 percentage of lost share value if the price per share drops below the amount of the investor's initial investment, in order to return the investor's holdings to their full value. I see. Taking the same scenario as above, if you had invested in Foursquare with full ratchet anti-dilution, we've sketched a possible outcome. Imagine you invested 500,000 the round at a 700 million valuation. You bought 38,640 shares at 12.94 per share with full ratchet. That's it. Right, Foursquare later goes on to raise three Series E round at a 307 million post money valuation. And the price per share drops by 69% to that. Now your shares are that much, the 150,000, 69% less valuation. Full ratchet anti-dilution rights dictate that in this scenario, Foursquare would need to issue additional shares to make up for the 69% decrease in share values. To retain your holdings in the company to their initial 500,000 value, Foursquare would have to issue an additional 86,410 shares to you at a 4.01 per share valuation to compensate for the 346,504 in lost value of your investment. Broad-based weighted average. Okay, that's it for this video. We're gonna go over the rest. We learned a little bit of the anti-dilution. Seems interesting. I didn't know all of this. Hopefully this allows me at least, to understand a little bit more about the startup investing, and what I really want to do is apply these and understand what is actually happening in the actual world. So in civil cases, people promises, this, that, interesting stories. So finishing this video, bye for now.